Okay, I wanted to, this is joint work with Chris Gerardi of the Atlanta Fed and David Zhang, who's a grad student at Harvard. First of all, I'd like to thank the organizers for including us. This is new work, so we're looking forward to comments and feedback. But let me start by just saying that I'm speaking today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed or the Federal Reserve System. And so when I say we, I'm referring to my co-authors and not my colleagues in the Federal Reserve System. Okay, so the starting point for this paper is a fact that has gotten a lot of attention recently, which is the fact that Black borrowers pay higher interest rates at the origination of mortgages than white borrowers. And this gap, this is just the raw gap, not controlling for anything, but this is typical of what people have found, which is a small gap somewhere in the order of maybe 5 basis points, somewhere in that range, controlling for observable differences. And so the first thing we're going to point out here is this is the gap that at origination of the mortgage. But if you do something different, which is to look, rather than looking at new mortgages originated, you just look at the distribution of interest rates for all outstanding mortgages, you get a gap that is much more persistent and much bigger. So somewhere on the order of 35 to 40 basis point gap. And this is, in other words, we're just taking all borrowers in the sample, all outstanding loans. We did a survey. This is what you would find. So why is this gap so much bigger? And what we're going to argue is the difference has to do with prepayment speeds. It has to do with the fact that that non-Hispanic white borrowers prepay much more frequently. And so it's the distribution not of the rates. It's not because there's a difference in the rate they get when they get the mortgage. It's because of the timing of when they get those mortgages. And so we'll show that there are differences. Some of this gap is based on kind of observable differences. Black borrowers have lower credit scores and higher loan to value ratios. They're more likely to be women, and women in general refinance less. But the other thing we'll show is that there's a lot of this gap comes from not from just a difference in the mean, but from a difference in the sensitivity to the option to refinance, the sensitivity to the difference in interest rates. That said, at the end of the day, we're also going to show that there does appear to be a kind of persistent race effect. In other words, even if we control for everything, there's still a difference in prepayment speeds. And then what we're going to link this to is the fact that prepayment and refinancing has become a central instrument of monetary policy, especially through QE. And what we'll show is that it means that in periods where monetary policy is expansionary, this gap in interest rates between Black and non-Hispanic white borrowers grows significantly. And so in some sense, the monetary policy, the way it's implemented now, ends up having a disparate impact on Black versus non-Hispanic white borrowers. Okay, so the main sample, I won't go into too much detail, the main sample that we're going to use is a merged sample of fixed rate mortgages. We use 2 different data sets here. There's McDash, which is an administrative data set of mortgages, so it tells you about whether the borrower is delinquent or whether they're prepaid, and that gives you a lot of information about the origination of the mortgage, what the credit score was, what the loan to value ratio, and so forth. And we're linking that to the Home Mortgage Disclosure Act data, which really just adds income, race, and gender of the borrower at the time of the origination of the mortgage. And so in the other pictures I gave you, we went back earlier. But the McDash data is only really reliable for origination starting in 2005. And so the first point there, the original point, the starting point, the first quarter of 2005 here, by construction, the interest rate on all outstanding loans and the interest rate on all new loans is going to be the same because all the loans are new. And so then over time, we'll watch this gap wax and wane, and you'll see, so the red line there, that's the difference in interest rates for new loans, and then the blue line is the difference in interest rates for all outstanding loans. And over time, you see this gap emerge. So where does this gap come from? So what we did to get at this was to conduct an exercise. And so what we did was we said, suppose that when the loans are originated, when new mortgages are originated, let's imagine that everybody, regardless of race, but also regardless of credit score, regardless of anything, everybody gets the same interest rate, right? And so on new loans, there's no gap between the between black and non-Hispanic white, but in fact, between any two different borrowers. And so what happens to the gap between the interest rate paid by black borrowers and non-Hispanic white borrowers? And you see here that a gap emerges, and this gap can only come from the fact that the timing of getting the mortgages is different for black borrowers and white borrowers. And then what we can do is compare this gap, which has nothing, which only results from timing, with the gap in the top panel, which comes from all kinds of things. And what you see here is most of the gap between new loans and active loans, most of that gap comes from this timing of originations, not from anything about the originations themselves. And so this is for all loans in our sample. If we limit the sample to loans originated by Fannie Mae and Freddie Mac, the gap is much bigger. It's on the order of 50 to 60 basis points. And again, we see the same thing here with the same pattern if we do this exercise of holding interest rates constant at the time of origination. Okay, so turning to the monetary policy, if we QE1, so the first iteration of QE furnishes the test for us because it was an unexpected policy-driven reduction in rates. And you can see the announcement of QE1 coincides with this huge increase in the gap between black and white borrowers. And so what we can do is to run a regression, and the first regression here, the pre-period here, is before the announcement of QE1, and the post period is after. And what you see here is that for the white borrower, for non-Hispanic white borrowers, in the 6 months after, the average rate paid by a non-Hispanic white borrower went down by 22 basis points. That's not the new originations, that's in the mean in the population as a whole. Whereas for black borrowers, it went down to minus 22 plus 1.12. So in other words, down by only 10 basis points. And that's essentially what we're getting. That's in the very beginning period here of QE. So we're comparing the 6 months after with the 6 months before. Okay, so where is this coming from? So this picture here, this is the prepayment hazard for non-Hispanic white borrowers. And you can see for much of the life of the loan, it's around 4 percentage points per quarter. So a little more, so probably about 20% of borrowers prepay every year. That's for non-Hispanic white borrowers. If we compare this with black and Hispanic white borrowers, you can see that prepayment hazards are dramatically lower. When we do a regression, the gap, rough gap, when we control for everything between black, not control for everything, just control for quarters since origination, so the regression equivalent of this picture, we get a gap of about 170 basis points. Okay, so the controls, we can go in and we can say, all right, well, how much of this is due to things in the data that we typically use, we might imagine would predict the probability of prepayment, and the variables like credit score and LTV. From HMDA, we have gender and income, and then we're going to put in a full set of zip by quarter fixed effects. And that means that that covers any any differences that we could measure, for example, in the census. This supersedes anything, for example, census level differences in education or in particular industries. And then the quarter fixed effects, the fact that zip by quarter means we'll pick up anything So for example, if there's an unobserved shock to house prices in a particular zip code in a particular quarter, that makes it more difficult for people to refinance, that'll pick this up. And when we do that, that wipes out about half of the effect of race. And so just so you understand what this says, it's saying if we take a black borrower and a non-Hispanic white borrower in the same credit score, the same equity, with the same time, the same zip code, the same gender, the same refi incentive, everything is the same, then we'll see about an 80 basis point difference in prepayment probability for black borrowers versus white borrowers. So there's some results that I'm going to mention now, although I can't discuss in any detail because they're based on data that we can't circulate yet. But when we use matched credit bureau data, so we have another sample in which we can match this with credit bureau data. Right now, we're just looking at prepayments. We don't know whether it's a refi or a sale. With the matched credit bureau data, we can identify whether it's a refi or a sale. We have an updated credit score, so we know what the credit score of the borrower is, at every moment when they're a candidate for refinancing. And in this case, it reduces the race effect by 70 basis points. So instead of going down 70%, so instead of going down from 170 to 80, it goes down by the gap that is left is maybe half that, so around 40 basis points. So there's still a race effect, but a lot of this difference is explained by, there are a lot of parts of the difference that are explained by the usual observable variables that we look at. Okay, but the interesting thing is if we delve a little deeper into the difference in the way different groups behave, one of the key things in understanding refinancing is the gap between the interest rate you're paying now and the interest rate that you could get if you refinance. And so what we do here is we take the interest rate, RIT is the interest rate of borrower of household I at time T, that's the interest rate they're paying. And then the Freddie Mac rate would be the rate that they could get at time T. And so this is the effect for black borrowers. And you can see that, so a reduction in the rate of 1.6 percentage points leads to a little more than a doubling of the prepayment probability for black borrowers. But if we compare that with non-Hispanic white borrowers, for them, the same change in interest rates leads to something like a 3- or 4-fold increase in the probability. So it's about 4 percentage points versus a little over 1. And so basically what this tells us is that the gap is not because the mean probability of prepaying is different. It's not that overall, even though that would generate some of the differences that we see, what's important here is it's the response to changes in interest rates, which is particularly important when we're thinking about quantitative easing and about policy. Okay, so to go back to the QE, we can start here just to understand about the effect on prepayment and on refinancing of QE, of doing a little event study. So QE was announced on November 25th, 2008. And this is the ratio of applications. So we know from the Home Mortgage Disclosure Act data, we can see the date of the application. And so these are applications by day, and we've normalized the ratio. So this is the ratio of non-Hispanic white applications to black applications, and we've normalized it to the day before quantitative easing was announced. So that's 100 is the day before, and this is what happened after the announcement. So in other words, on the day of the announcement, white applications went up 50% relative to black on that day. And that persisted, as you'll see in just a second, persisted basically for the next several years. This is for all applications. The number, if we just focus on refinance applications, the effect is even bigger because this includes purchases, which didn't change that much around the announcement of QE. And so there's a huge effect relative effect on the day. And this is then the prepayments, which we were looking at before, and this is again around the time of QE, and this is for black borrowers. And then if we put white borrowers in, you see the same thing. This is the applications, and this is on the other side, this is the borrowers prepaying. And you can see that it spikes dramatically for white borrowers, and there is an increase for black borrowers around the same time, but it's much smaller, and that persists all the way through QE2, QE3, and then of course when the taper happens and interest rates go up again, everybody stops refinancing. Okay, so let me conclude by mentioning that there are some additional findings in the paper which I did not discuss, but I'll briefly mention. The first is that in addition to looking at prepayment, we also look at default. So there are, in the case of default, it's interesting, we do the same exercise. We see how much of the differences, so unconditionally, black borrowers are much more likely to default than non-Hispanic white borrowers, but with default, all of that difference can be explained by observable characteristics. And in fact, conditional on all the observables, we actually find that black borrowers are slightly less likely to default than white borrowers. So this is distinct from prepayment, where there's still a gap once we control for everything. If we put in credit score, we put in LTV and all those things, then we explain the difference. Another thing we look at is loan pricing. Lower prepayment speeds imply that black borrowers should pay lower rates, and we provide some estimates. We say it should be between 5 and 10 basis points. So future directions for research. One of the issues here is mortgage design. This has always been an issue between economists and the rest of the world. We love adjustable rate mortgages. Everybody else hates them. Adjustable rate mortgages allow the transmission of monetary policy without refinances. It does not require that someone go through some complicated financial transaction in order to take advantage of lower interest rates. And then more generally, for future study here, questions about why it is that black borrowers refinance less. One issue may be financial literacy. Another issue is social networking. There's a paper by Maturana and Nickerson which is able to identify how it's within a school, they're able to show that the timing of when people have breaks in the school, and that's when they talk to each other, those people are more likely, if one person has a break at a certain time who refinance, other people who have breaks at the same time are also more likely to refinance. So that is, those are all questions which we could pursue going forward. Okay, Peter?
Okay, so this is an excellent paper. I want to thank the organizers for giving me the chance to discuss it. And I want to congratulate the authors on addressing a very important question, or set of questions, really. And so, if you think about it, what this paper does is it's really bringing us a set of new facts about household mortgage rates and prepayment. And in particular, there's a lot of previous research, as Paul says, that looks at prepayment, and looks at prepayment as a function of all sorts of observable characteristics. But what's different about this paper, and I'll say more about this in a second, is that it's really taking a look at what the authors call a flow effect versus a stock effect. Okay, so in this paper, it says the propensity to prepay significantly correlated with race and ethnicity, and this matters greatly during a period of dramatic decline in interest rates. So in other words, previous research hasn't really thought about the role of race potentially in prepayment. And so one of the key facts here are that from 2010 to 2014, as Paul documents, black borrowers were paying 30 to 45 basis points more on their mortgage rates than non-Hispanic whites. And this flow effect, is again very different than effects that people have looked at before, which is to sort of say, are there, previous work has basically said, are there differences in mortgage rates at the time of origination that could be due to discrimination or other effects correlated with race? And this paper is really saying, let's actually look to see what happens to mortgage rates during a period when there's a significant decline in interest rates. There's a nice shock here, which is QE1. And the paper finds that essentially this flow effect is much more important than the stock effect, which has really been the focus of previous research. So I think this is a very, very important framing and an important new set of facts. And it gives us a different way of thinking about the impacts of changes in financial conditions on households, conditional on the race of those households. And in particular, it's saying that the differences in mortgage rates at origination may not be the first order effect here. So let me say a bit about this flow effect. So the flow effect is that this mortgage rate gap widens because A, interest rates fell, and B, non-Hispanic whites were much more likely to refinance their mortgages than non-whites, i.e. Blacks and Hispanics. And the reason, kind of just as Paul pointed out, that Black and Hispanics refinance less is because their propensity to prepay their mortgages is less than that of whites. And in particular, Paul did, I think, this is a very nice job, and his co-authors in the paper, of explaining and showing pretty convincingly that the sensitivity of prepayment by non-whites to changing financial conditions is very different than it is for whites. And in particular, what we find is that 2.84% of non-Hispanic white borrowers prepay every quarter versus 1.51% of Black borrowers. So that's kind of the unconditional difference, if I have that right. And then after controlling for a bunch of other factors, observables, credit scores, loan-to-value ratios, the loan amount, current equity, income, gender, and so forth, this difference still remains, and white borrowers, non-Hispanic white borrowers are more than 50% more likely to prepay than Black borrowers are. So my main comment is just about kind of the way the paper is framed, and in particular, how do we think about these new facts? What's the right kind of framing and narrative, if you will? And so, to my reading, the conclusion of the paper. I mean that conclusion in the broadest sense, because there are many things that the paper finds, but the kind of the theme of the conclusions really is that Black and Hispanic borrowers pay higher mortgage rates because they're less willing to prepay when their refinance options in the money. And that's a function, if you will, that conclusion of the sensitivity analysis. And as much as I like this paper, I really think it needs to think really hard about an alternative explanation. And the alternative explanation that I would propose, and again, I'm not an expert in household finance, but this does seem to me to be an important place to look, is that Black and Hispanic borrowers pay higher mortgage rates because they're less able to prepay when the refinance option is in the money. So why might Black and Hispanic borrowers have less ability to prepay? Well, liquidity constraints could be an important factor. Right? Namely, there's an enormous, a really enormous racial wealth gap in the United States that cannot be explained by differences in income or propensity to save. And I think in particular, the work by Sandy Gerardi, William Gerardi Jr., and Derek Hamilton, in their paper in the Review of Black Political Economy, discusses some of these facts in great detail. And so just the way to think about this is, so you've got a shock to interest rates, which would make you better off if you were to refinance a fixed rate mortgage. But when that shock in interest rates happen, it happens in a context, right? So in particular, QE1 happened in the context of the greatest financial crisis since the Great Depression. And so if households are rational, right, and even if their lifetime income hasn't fallen by as much as their current income, particularly in the context of Black and Hispanic households where homeowners may have responsibility for kind of supporting other family members who are not in that household. You think about kind of historical inequalities, which I'm going to talk about in a second, then they rationally anticipate greater need for sort of family burden sharing, then that could be one reason why you're less likely, particularly at the time of a large shock, to actually prepay, because you're going to have other liquidity needs. So I just want to share some data just to give you a sense of just how important are these wealth effects. Well, they're pretty doggone important. In 2016, the median net worth for white households was $171,000 versus $17,150 for blacks. So there's an order of magnitude of a tenfold difference in black-white household net worth. So this is a big number, and you can see the numbers for Hispanics pretty much track the numbers for blacks. So we're talking big differences, enormous differences really for black and Hispanic households. And if you ask the question, is that true? Kind of across the board. In other words, is this true if you controlling for things like income? Because you might say, well, the wealth gap is a function of income. Well, even when you control for income, there's still a huge difference in wealth between blacks and whites. Right? So for families in the top 10% of income, the median net worth for whites is $1.8 million effectively. And for blacks, it's closer to $340,000. So still, a five-fold difference in median net worth for blacks and whites, even in the top, the top decile of the income distribution. So these wealth effects are really large and really, I think, quite significant. So kind of my final thought related to this observation is that the paper really focuses on the willingness of borrowers to prepay, but ability to prepay depends on monthly liquidity, which is a function of income. And the authors do control for this. They're controlling for income, but liquidity depends much more on wealth than on income. And we know from the numbers that I just shared with you that the racial gap swamps differences in the racial income gap. So these wealth gaps versus income gaps, I think, are really quite significant. It's not clear to me that the zip code effect regressions take care of the wealth gap issue. And let me just say, I don't know that the authors can actually do anything to control for these big wealth gaps. I don't know that there's data to do that. So my main comment here is I think this paper provides an excellent contribution. I think it's a very important paper. I think it moves the discussion forward to show that, in some sense, there are not so many that the de jure, if you will, kind of differences in mortgage rates are not nearly as important as the de facto ones which come about as a result of certain financial shocks. But to the extent that if you will, the de facto differences in mortgage rates are, the authors clearly show that they're correlated with race, and the question is why. And I think just before jumping to kind of policy conclusions that are rooted in sort of behavioral explanations, I would like to see more thought and consideration given to an alternative behavioral explanation, which is that this is a totally rational response. That's a function of differences in wealth of the households themselves, and potentially also a function of the differences in obligations of households with limited wealth for other household relations of even more sort of wealth-constrained capacity. So in short then, important as this paper is, it would benefit from serious consideration and discussion of the implications of A, the racial wealth gap literature and its implications for households' ability at varying levels of income to exercise in the money prepayment options. And I would specifically emphasize the importance of the work of Sandy Gerardi and Derek Hamilton and a litany of others who they cite. And B, also, how do we think about how to interpret the results, given that the authors may not have, or in fact be able to obtain granular data on the cross-sectional variation in wealth by race and household. And even if the authors can't control for this themselves in their own work, I think it's very important for them to talk about it and mention it, and to push the literature in the direction of saying, actually, we need much more data on, sort of granular data on wealth by race and household. So with that, let me conclude my remarks and open it up for questions. So Paul, I'll give you a chance to respond. Or, Paul, do you want Paul, why don't we, if it's okay with you, Paul, let's take some other questions and then you can respond to them all. Is that okay?
That's great.
Okay. So if I go to the chat room here, trying to find my chat room here. You've got a few questions. I won't take all of them. So one question from Hanning Fang is, is there a systematic racial gap in the mortgages with prepayment penalties in the original mortgage? It gets to the question of why there's such a large racial gap in prepayment. And Paul, I guess you can probably see these questions as well as I can, so
Yeah.
probably no need for you to read them. So why don't I just turn it over to you to respond as well as my comments.
So just to say thank you, Peter, for those excellent comments. To Han Ming's question, the answer is no. In this sample, there are prepayment penalties are very rare. So in the past, so these are all fixed rate mortgages, and in particular, the sample where we see the biggest difference are agency prepayment mortgages, so Fannie and Freddie, in which there are rarely ever prepayment penalties. In the past, back with subprime, prepayment penalties were more of an issue, but for this sample, none of the loans that we're looking at, or almost none, have prepayment penalties. And obviously, for what it's worth, it's actually that is an easy thing for us to control if there are. Okay, so should I choose the questions here?
Go ahead.
All right, so Marcus, to your question about MBS prices, so we don't, none of the data that the investors get has race in it. So we're able to match it with the HMDA data, although to do that, we actually use confidential HMDA data, which was not publicly available, and to make matters even worse, which comes out with a long lag. So we're just getting the 2019 HMDA data now. The simple fact is that if you're looking at a pool, it's not one of the variables that is easy to see. It's possible that investors, are able to triangulate out the racial composition of loans in a pool, and that would be an interesting thing to look at whether we pick up pricing differences there. Well, I'll take on Raphael's question about willing and able, which will also allow me to respond to Peter. I want to say, just to be clear here, the fixed effect, right, is an average residual, and in some sense, I think I can see why, now that you mention it, that the way it's written, it might imply that we're saying it's something about Black borrowers that's inherently different from white borrowers that's causing this, but that's not the intent. That's not our belief. Our belief is that it's picking up something that's different that we can't observe in our data. And so wealth is absolutely one of them. It covers a whole long list of things. I want to say, just personally, I find going through getting a refinance somewhat traumatic. And I work for the Federal Reserve, and that it's somewhat, you're sort of putting yourself out there. There's a possibility of rejection. It's very intrusive. They're asking you all kinds of personal questions about your life. And so I do think, again, this is one of these things that there's a certain level of trust in the financial system that you have to subject yourself to this repeatedly. But I will also say that we have a lot more information in the data set that I can't talk about. And to some extent, some of these questions that you're raising can be addressed more precisely.
It's great. I think we've got time for maybe to address one more question, Paul. We're a little bit over time, but there's a lot of questions out there.
What is the sample size for refined sentence regression results? The sample sizes here are enormous. So the data set has something like 30 million observations. I think we're using a 10% sample or something. So we're in the millions. So there's no, I mean, that doesn't mean that the standard errors are right. It just means that they are, it's not because of sample size. I think just to conclude here, this question of why is the sensitivity lower is obviously, as an economist, is the interesting question. I think as far as the policy making goes, I would like to say that even if we could explain all of the difference, say, with credit scores, it still means that this is a policy which has a different effect on different groups. That's the point of disparate impact. And, I think it gets at this fact that when we think about making policy decisions, we sort of think about the representative borrower. It's very easy. Well, we don't even think about the representative borrower. I think we think introspectively about, well, I refinanced, so, anybody can refinance. And that's why, as I said, in some sense, it's not clear as far as policy goes that it matters that much why. It just matters that there's a difference.